now is Ben Emmons. He's the founder and CIO at FedWatch Advisors. Ben, welcome to the New York Stock Exchange.
Thank you. Good morning.
All right, so let's talk Fed. So investors are pricing in an 87% chance of a rate cut in September. Do you think that there's anything that can happen that can impact the decision the Fed might make before that September meeting?
Well, the only thing that stands in the way is this payroll report coming out next week, because that's what really matters now, right? That's how they got to this rate cut conversation in the first place. The last report was so weak, it showed so much revisions, that within the Fed I got quickly worried about this might run away from us. The unemployment rate may suddenly jump and then we cannot stop it. So Powell has signaled it, we had Williams signaling it yesterday. There are others on board, so unless that report next week is so strong, like it's like a blockbuster report and all the revisions are flipped around to the other side, like it's all revised upward, maybe then you could have a doubt, but I actually doubt it. I think they just made the decision to say, we got enough to make a case for a rate cut, but if it's a strong report, then it may not be a rate cut in October. That probably will play there.
All right, so if the Fed does cut rates, what does that mean for Treasury yields?
Well, initially, the shorter end of the yield curve, 2-year yields, should decline a bit further because they discount the path of where the Fed will be heading in the future. But if you're cutting rates in an economy that shows strength, like we're seeing with the GDP report this morning, for example, which is backward-looking data but was actually stronger than expected, you're going to see long-term interest rates go up because if you cut rates, you stimulate the economy, typically leads to a little bit higher long-term rates. So until we actually cut the rates, that's one that will happen, I think. This happened last year too. So I think it's still a bit of a case about you want mortgage rates to go down and there's a lot of attention to that. But if you cut rates too fast in a strong economy, unfortunately, mortgage rates are likely going to go higher.
All right, and what else do people need to know about these yields right now? And should they be taking any action?
Well, it doesn't reflect much of any type of risk one way or the other. I think it's because we're kind of stuck where we are. So people are, a lot of attention to the Fed and what's happening with Governor Cook and all that sort of stuff, but that's not really in the price of the treasuries because they're more focused on what's the economy doing, where it's heading, and what will the Fed really take from here. We know there's going to be a rate cut, but going to be more cuts. How many? How deep is that cut? And that sort of discussion. So yields are going to kind of sitting in a range until we're getting more clarity. And I think we will get more clarity in September.
All right, and we had GDP data come out this morning, weekly jobless claims. PCE data, which is the Fed's preferred inflation gauge, is coming out tomorrow. What should we be on the lookout for?
Well, that last point, the PCE data, it was quite stable in the GDP report. There's another measure like that has a decent idea of what the PCE report could be tomorrow. So that's at least comforting because it doesn't mean that all the tariffs and everything that we've had hasn't led to a real acceleration of inflation. It's a little stickier, a little higher, but it's not a concern. So that's to be watched. But what I found interesting with the GDP report this morning was that you have a lot of components of investment in there. Those are all up. Those are almost stronger than expected. So what's going to play in this third quarter is the investment that all these countries and companies have committed themselves to the administration for zero tariffs or low tariffs, that actually starts to happen. So some of it is already happening. That's, I think, an important information for the markets.
So your firm helps people invest in the Fed. What does that mean?
Yeah, it came from a client actually who told me one day, great stuff about this Fed and nuance, but how do I invest? So it came down to a strategy and kind of quantify the language of the Fed into a tradable signal. But what I also do is take that model and help people understand what is interest rate risk in your portfolio doing today and how can you better manage that interest rate risk. Because as we now learned over the last several years, interest rates are not only higher than normal, but they're more volatile than normal. And I think that is an issue because there's so many different type of risks that are out now that are influencing interest rates. It requires more diversification. So that's part of what I do.
All right, so we're about a week away from the August jobs report. How should investors prepare? What should they be looking for?
Well, as I mentioned, it could be a surprise that the employment report is actually a bit stronger than expected. There's some data out on it that is PMI data that shows there's intentions of hiring are picking up again by companies. I guess they're feeling more confident about the tariffs and everything that's happening. So we got to watch that because before the report we're getting JOLTS data, claims data and that sort of thing. So it will be dominating the price action. I think that's how to try to navigate this. If it's an upside surprise, we say, like a bigger surprise than expected, some of these rate expectations will moderate, and that will be a change. So you could have an effect on interest rates and on the stock market.
There's so many eyes on the Fed right now, so much talk of the Fed and how it's affecting markets. What else should we keep in mind?
Well, I mean, where's the US economy really heading, given the tariffs that we put in place and how it's affecting the economy? Then obviously anything that comes out of the trade agreements with China, that matters now, because that starts to play into the third quarter. They're going to try to come up with a deal. It's the only country that the US has not closed a trade deal with it yet. And that's always a very tricky situation, either way. And then lastly, it's really the AI developments. You know, we're seeing it with NVIDIA earnings, maybe a little bit on the disappointing side, but these numbers are really strong. That continues to drive the economy, though. There's a lot of investment spending in AI, and as that gets more and more invested in, AI is going to continue to influence how we work, how we operate. So it's changing the economy. I think you should watch for that.
Ben Emmons, founder and CIO at FedWatch Advisors, thank you so much for joining us at the New York Stock Exchange.
Thank you.
Still to come.